In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about how India and the UK are now finally sealing a major trade deal after multiple years of negotiation and why it is quietly marking a shift in global trade strategy. And in the second story of the day, I'll talk about why Tata Motors is splitting up after years of quietly preparing for this very moment. Welcome to the Daily View show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Thursday, the 8th of May. After many years of back and forth, India and the UK are finally signing off a major trade deal. Now, mind you, this is not a minor update or even a routine diplomatic agreement. It is actually a full-fledged free trade agreement, which is something that both of these countries have been trying to pull off ever since the COVID era, which is back when Boris Johnson was the UK Prime Minister and Narendra Modi first announced plans for a deeper economic partnership between these two nations. Now, something important to remember here is that the deal has not been officially signed yet. The legal draft of the agreement is still being finalized, but both the countries have more or less agreed on the terms. And barring any sort of last minute hiccups that could come up, the agreement should be signed very soon and should come into effect as early as next year. Now, the reason why this is important and is a bit of a big deal is because this particular deal is part of a much bigger shift. See, both India and the UK have been rethinking how they approach global trade lately, and this agreement sort of reflects those deeper changes itself. Let's take a look at UK first. See, for decades, the UK built its economy around being Europe's go-to destination for services. Whether it was banking, law, consulting, or accounting, British firms serviced clients all across Europe from a single office in London, all thanks to something called passporting rights. Now, these rights basically allowed UK-based firms to offer services freely across the European Union, which was a big deal considering that nearly 80% of the UK's economy is based on services. But then Brexit changed sort of everything. When UK left the European Union, it also lost these passporting rights, and that meant that British firms could no longer freely sell services across Europe in the same way that they earlier used to. Now, some of them adapted by setting up shops in European Union countries and also getting local licenses. But the old advantage was obviously gone. And on the goods side, things were not much better either. The UK's goods exports have been struggling ever since Brexit, so the country had to start looking elsewhere, which is beyond Europe, for new markets. They began building relationships in the Indo-Pacific region, and they signed trade deals with countries like Australia and Japan. The idea was basically to find new fast-growing markets that could somewhat replace the lost European Union access. And the trade deal with India is a key part of this particular broader strategy. Basically, India is one of the fastest growing major economies in the world, and the UK basically wants a foot in. Now let's move on and take a look at things from India's point of view. See, India has traditionally been cautious when it comes to trade agreements in general. Many of the old trade deals that were signed in the past were sort of heavily tilted towards goods, and that meant that we opened up our market to imports, which meant letting others sell to us easily, but we did not really do enough to promote our own strengths, especially in areas like IT services and pharmaceuticals. And to make things even worse for India, we lost several high-profile legal disputes under international investment treaties, which made the government even more skeptical of signing broad binding agreements. But starting in 2016, India began to unwind many of these older deals. We cancelled 75 of our 83 bilateral investment treaties, and we pulled out of negotiations for big multilateral agreements like the Regional Comprehensive Economic Partnership, or the RCEP. And instead, we took a more careful approach to this. The goal was now to sign smaller and more targeted trade deals with wealthier countries which had something that we needed and who also needed something that we had. And that is exactly why we signed deals with UAE and Australia in the recent years. And that is also why the deal with the UK is so significant here. It is one of the biggest and the most balanced trade agreements that we have pursued under this new strategy. But in order to understand where things exactly stand between India and the UK, it's very useful to look at the numbers first. See, the UK is India's 16th largest trading partner, while India ranks at 12th for the UK. And that means that we are important to each other, but yet not on the top tier. The total trade between the two countries last year was around 42.6 billion pounds, or just around 5 lakh crore rupees. But that number has steadily been rising over the last 5 years or so. And when it comes to goods, the UK mostly exports metals to India, and we on the other hand send a more diverse range of products, especially garments and pharmaceutical kinds. But the real action is in services here, and that is where the bulk of our economic exchange also happens. See, interestingly, one of UK's biggest exports to India is travel. So when an Indian tourist basically goes to the UK and spends money there, that actually counts as service exports for the UK. And meanwhile, India exports billions worth of businesses and IT services to the UK, where you can think of companies like Infosys or TCS doing back-end work or consultancy for British firms. Anyway, now let's get on to what the deal actually includes, at least based on what we know so far. See, the final text has not been released like I mentioned, but the UK government has published a policy note which gives us a great idea of what exactly to expect. See, on the good side, the big win for India is access. Nearly 99% of Indian goods will be allowed into the UK duty-free. And that sounds impressive, but it is worth remembering that the UK already had fairly low tariffs, averaging at around 5%. But still, this will help Indian exporters in specific sectors. For example, the 9% duty on garments will be removed, which could give a boost to India's textile industry. Our shrimp exporters also stand to benefit from an 8% cut in tariffs. And from the UK's perspective, the benefits are a bit more niche. See, the UK is not a big exporter of mass market goods, but it does well in high-end areas. And this deal makes it easier for British food and beverage companies. You can think of whiskey makers and chocolate brands, as well as advanced manufacturers like medical device and aircraft engine companies to sell to our country, India. And in exchange for this, India has made two major tariff concessions. First, we are bringing down duties on imported whiskey from a massive 150% to half of it, which is 75%, and then eventually to 40% over the next 10 years or so. Second, we are slashing car import duties from 100% to 10%, but only for a quota of 22,000 high-end vehicles. So basically, this is not about flooding the market with cheap British cars, but more about giving a little bit of a breathing room to premium brands to operate in our country. Now, that's the goods part. But since both of these countries are service-driven economies at large, the real meat of this deal actually lies in services and the movement of professionals. See, India has agreed to let British service firms in areas like telecom, construction and more to operate in India freely without needing to open a physical office or go through any special licensing processes. Now that is a big win for UK companies, and more importantly, these rights are sort of locked in, which means future governments cannot just roll them back without violating the deal. And in return, India gets easier access for its own professionals, IT workers, consultants, educators and many more people who often work with UK firms will now face fewer restrictions. There is also a push to mutually recognize professional qualifications. For example, Indian chartered accountants might soon be able to work in the UK without sort of re-qualifying from scratch for them. Then there is also the topic of visas. See, business travelers from India will now find it easier to get short-term visas. Independent workers like, say, chefs, yoga teachers, artists, etc. may also benefit because of this. Plus, Indians who move from the UK for short stints, say less than 3 years, will not have to pay for the UK's social security programs anymore. Now, that on an average is a saving of about 20% of their income, which is definitely a big deal. But that said, beyond these major elements, there are some smaller but still very important features in this deal. Both countries have agreed to accept things like e-signatures and digital customs documents, which should make trade faster and also smoother. They have also promised to allow freer cross-border data flows, which helps tech and digital services companies operate across both these markets. Then there is also a joint commitment to cut down on spam by both the countries. Another very interesting point here is that UK companies will now be allowed to bid for Indian government tenders as well. The catch though is that they need a presence in India to do so, but once that is set up, they can offer everything from IT services to logistics to our government. The question then is, what does all of this add up to? See, in simple terms, this is a solid, well-balanced deal. It won't really transform India's foreign trade massively, and it won't suddenly make the UK our biggest economic partner either. And even if the trade between our two countries doubles by 2030, the UK would still lag behind countries like the US, China or UAE in terms of total volume. But it does signal something much more meaningful, which is a deliberate and thoughtful shift in how India is approaching global trade. Instead of being overly generous or overly protective for that matter, we are now looking to pursue deals which actually play to our strengths. And in a world where global supply chains are becoming harder to navigate in and trade relationships are becoming more and more uncertain as time progresses, this kind of stable and mutually beneficial partnership is sort of worth its weight in gold, to be honest. On that note, let's move on to the second story of the day. See, Tata Motors is going through a very big change right now. The company is splitting itself into two parts, and the split or a demerger is now official. The question is, what's exactly happening? I'll explain. See, Tata Motors has announced that it will separate its commercial vehicles business, which by the way includes trucks, buses and other heavy duty vehicles, into an entirely new company now. Now, this company will be separately listed on the stock exchange, just like Tata Motors is today. Meanwhile, the remaining part of Tata Motors, which includes its passenger car division, its fast-growing electric vehicle unit, and also the global luxury brand like Jaguar Land Rover, will continue as a separate listed company. Now, if you already own Tata Motors shares, nothing is being taken away from you. You will simply get equivalent shares of the newly formed company for every share of Tata Motors that you already own. Basically, in short, instead of one company doing many things now, there will now be two companies who are each focused on doing one thing really well. But that's not really the story that I want to talk about today. The thing is, it's not just something that came out of nowhere. This has actually been in the works for quite some time. And to understand the details of what's exactly happening and more importantly why, let's very quickly zoom back to 2017 for once. See, at that time, Tata Motors was in a very difficult spot. Their cars were not doing great in the market and people were not really impressed with the quality of the after-sales service as well. And its most ambitious project, which is the Tata Nano, which was supposed to be the car for every Indian, had also failed to take off. And to make things worse for them, competitors like Maruti Suzuki and Hyundai were dominating the market very well. And that is when N. Chandrasekhan stepped in as the chairman of Tata Sons, which is the parent company. He had a simple task, which is to fix Tata Motors, and that meant going back to the drawing board of sorts. Now, the company began reviewing its structure and they realized that it was running multiple types of businesses under one umbrella, which is commercial vehicles, passenger cars, luxury cars, and also electric vehicles. Now, these, mind you, are completely different markets with very different customers, different manufacturing needs, and also different growth opportunities. And of course, managing them all together under a single umbrella was very hard to do. So they started splitting these parts internally and gave each division its own leadership, budgets, and operational independence. And by 2020, Tata Motors had decided to formally carve out its passenger vehicles business, including electric vehicles, into a separate subsidiary altogether. And this shift was completed by around January 2022. And around the same period, it raised $1 billion from TPG Climate Fund by selling a small stake in the newly created EV arm. And this move gave its electric vehicle ambitions a major boost, both in terms of funding and market confidence. From 2021 onwards, Tata Motors started operating in three separate verticals. One was commercial vehicles, which, as you may know, includes trucks, buses, etc., which most Indians are used to seeing on highways and city streets. The second was passenger vehicles, which includes their cars like Punch, Harrier, Nexon, and also their electric versions. Now, this was under the Tata Motor Passenger Vehicles Limited, or TMPV, with a dedicated EV arm called Tata Passenger Electric Mobility Limited. The third part was Jaguar Land Rover, which was a British luxury car company that Tata had acquired back in 2008. And each of these businesses was given its own CEO and functioned quite independently, even though legally they were still a part of the same parent company. Now, this internal separation basically helped Tata Motors run more efficiently, but there was still a big limitation, which was to the outside world, this was still only one company. Investors had to evaluate Tata Motors as a single stock, which made it very hard for people to appreciate the strengths of each individual businesses. And this brings me back to the demerger announcement that was made in March 2024. See, Tata Motors said that it would now go one step further and officially break itself up. The commercial vehicles business will be spun off into a new company, which would tentatively at that time be called TML Commercial Vehicles, and meanwhile TMPV, which housed the passenger vehicle and the electric vehicle units, will be merged back into Tata Motors, which will continue to also own JLR or Jaguar Land Rover. And after that, in order to avoid any confusion, the company names will be updated as well. The commercial vehicle company will retain the name Tata Motors Limited, while the other entity will take the name Tata Motors Passenger Vehicles Limited. So even though the names are still a little bit confusing, the structure is now very clear. Trucks and buses in one company, passenger vehicles, electric vehicles, and JLR in another company. But now comes the important question. Why is Tata Motors exactly doing this? See, there are a few important reasons. First, this change makes it easier for each business to operate with more freedom, like I mentioned. While the internal separation helped for sure, there were still overlaps when it came to decision making, funding, and even investor perception. And as two independently listed companies, each division will now get full control over its strategy, capital, and also priorities. The second is that it's a move designed to unlock value. Investors are increasingly excited about electric vehicles and future mobility businesses, and Tata's EV arm alone was valued at over 60,000 crore rupees when it raised money from TPG. But as long as that business stayed hidden under the broader Tata Motors umbrella, which includes the cyclical and slower growing commercial vehicle segment, many investors were not fully recognizing its value. So by separating them, the company basically hopes that each part will be judged on its own merit, and that means investors who are bullish on electric vehicles or JLR can now invest in just that part of the business without really getting pulled down by the trucks and buses. And the same logic also, by the way, applies to the other side of the business. Those who believe in the country's infrastructure-led growth can now invest in the commercial vehicles business separately. Another big reason for this move, like I briefly mentioned, is also the nature of the commercial vehicles business itself. See, this business goes through various cycles. When the economy slows down or construction activity falls, demand for trucks and buses also starts to take a hit, and that makes it volatile by quite an extent. And by contrast, passenger vehicles and electric vehicle businesses are on a more stable growth path. And of course, putting them all under one single bucket makes it very hard for analysts to evaluate them clearly. And the demerger basically simplifies exactly that. Now, the question is, does all of this mean that the commercial vehicle business of Tata Motors is in trouble? See, not really at all. Despite a slight dip in revenues last year, Tata Motors remains the market leader in this space. They still sell more vehicles than anyone else with a very broad portfolio range covering multiple types of vehicles. Last year, they generated nearly 78,800 crore rupees in revenue, which was almost twice as much as its closest rival. And the profitability is improving as well. In the last quarter of 2024, its EBITDA margins, which basically show operating efficiency, hit 12.4%, and EBIT margins, which basically show core profit before interest and tax, were at 9.6%. And that puts it very close to Ashok Leyland, which is a very important competitor for them. So even as a standalone business, to be honest, Tata's commercial vehicle division seems steady and fairly competitive. Meanwhile, of course, the PV and the EV businesses are on a much higher growth trajectory, but with slightly thinner margins, at least for now. And that, of course, is expected given the kind of investments that are required to build scale in EVs and the price-sensitive nature of the Indian car market. So in many ways, operationally, not much changes after this merger. The teams, the products, and the leadership are already working independently, but on paper and in this market, this split now gives each business its own identity and also focus. On the downside, it also brings greater public scrutiny since each business will now be judged as a separate company altogether. But that's also a good thing because it allows each of them to attract the right investors, make faster decisions, and also unlock more value over the longer term. That brings me to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, Colgate-Palmolive India is grappling with major setback as its Maharashtra distributors under the All India Consumer Products Distribution Federation have announced that they will suspend purchases of its products from May 12th. The decision comes after distributors received GST notices demanding around 200 crore rupees due to trade credit notes issued without corresponding GST. Second, NLC India Renewables has signed a power purchase agreement with Rajasthan Rajya Vidyut Utpadan Nigam Limited for its 810 megawatt solar power project at Pugal Solar Park in Bikaner district. The project, which was awarded through a competitive tariff-based bidding process, is part of the Ministry of New and Renewable Energies Ultra Mega Renewable Energy and Power Park scheme. Third and the final one for the day, India has approved new rules allowing independent power producers to secure long-term coal supply contracts without needing power purchase agreements, aiming to accelerate coal-fired capacity expansion. Under the policy, producers can obtain coal through auctions for up to 25 years by paying a premium above the notified price. That's all the news and stories I have for you today. This is your host Anurag Bansal signing off. I'll see you in the next one. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.